December 2025. Silver is trading near $80 an ounce, up more than 170% this year alone. And yet, the most important thing happening in the silver market right now has almost nothing to do with the price. It has to do with who controls it. Because for the first time in decades, the power to set the price of silver is no longer firmly in the West. And that shift is accelerating. This is not a speculative frenzy. This is not retail hype. And it is no longer a niche metal story. This is an industrial, geopolitical, and structural event, one that even Elon Musk is now publicly warning about. And when someone like Musk starts talking about silver shortages, it's not an investment thesis. It's a supply chain alarm. For years, silver lived in a strange place, too industrial to be treated like gold, too monetary to be treated like copper. It sat quietly in the background while financial markets played paper games. Futures contracts, derivatives, leverage stacked on leverage. But that era is ending, because silver is now colliding with three unstoppable forces at the same time: the electrification of everything, the AI and data center boom, and a geopolitical reordering of global supply chains, and silver sits at the center of all three. Let's start with the most important point, one that almost no mainstream commentary fully acknowledges. Silver is irreplaceable, not politically irreplaceable, not economically inconvenient, physically irreplaceable. Silver has the highest electrical conductivity of any metal on Earth. Nothing conducts electricity better, nothing. Which means, in the technologies that matter most going forward, silver is not optional, it's mandatory. Take electric vehicles. Every EV uses significantly more silver than a traditional internal combustion car. But the real story isn't today's EVs, it's solid-state batteries. The next generation of batteries, the ones promising longer range, faster charging, and higher safety, rely heavily on silver-based components. These aren't nice-to-have improvements, they're required for EV adoption at scale. And without silver, those batteries don't work. Now move to space. SpaceX, Starship, satellite networks, advanced avionics, extreme environments, high reliability requirements. Silver is embedded throughout these systems, in circuits, connections, thermal management, and power transmission. When Elon Musk talks about silver shortages, he's not thinking about coin shops. He's thinking about whether his projects can source enough material to function. That's a very different kind of demand. Then there's AI, the most capital-intensive industrial build-out since the oil age. Massive data centers, high-density power loads, extreme heat, constant uptime. Every one of those data centers is packed with silver in power distribution, cooling systems, connectors, and advanced electronics. AI does not scale without silver, period. And here's the key point. When demand is industrial and existential, price becomes secondary. Factories don't shut down because silver is expensive. They shut down because silver is unavailable. This is why the silver market is behaving differently now. This is why old models are breaking. And this is why the paper price is struggling to keep up with physical reality. Because on the supply side, the situation is already critical. We are now in the 5th consecutive year of a global silver deficit. 5 years in a row where demand has exceeded supply. Not by a little, by hundreds of millions of ounces. Above ground stockpiles are being drawn down to fill the gap. And those stockpiles are not infinite. Look at COMEX inventories, down roughly 70% from their peak. That's not noise, that's depletion. And once inventories fall below a certain threshold, the market stops functioning smoothly. Because inventories are the buffer. They absorb shocks. They smooth volatility. And when the buffer disappears, every marginal buyer has to compete harder. Every delivery month becomes stressful. Every supply disruption becomes amplified. And now, just as inventories are thinning, the geopolitical squeeze begins. China already consumes more than half of the world's silver, more than 50%. Solar panels, electronics, EVs, grid infrastructure. And starting in 2026, China is implementing strict export licensing requirements for silver-related materials. This isn't speculation, it's policy. And the intent is clear. China is prioritizing its own industrial ecosystem, its own energy transition, its own technological expansion, which means less silver flowing outward and more staying inside. This is not hoarding in the emotional sense, it's strategic allocation. And when the world's largest consumer tightens exports during a structural deficit, the squeeze becomes global, because silver isn't produced where it's consumed, it has to move. And when it stops moving freely, prices adjust violently. Now here's where the real shift becomes visible, and this is the part most investors are still missing. The price of silver is no longer being set in New York or London, it's being set in Shanghai. On the Shanghai Gold Exchange, physical silver is trading at record highs, $8 per ounce higher than COMEX, more than 10% higher. That's not a rounding error, that's not arbitrage noise, that's a signal. Because Shanghai is a physical delivery market. Contracts there are settled with metal, real metal, delivered to industrial users, sovereign entities, and manufacturers. COMEX, by contrast, is a paper market. Derivatives, futures, leverage. Only a tiny fraction of contracts ever result in delivery. Most are rolled, netted, or settled in cash. In normal times, these two prices stay aligned. Arbitrage closes the gap, metal flows. But right now, the arbitrage isn't working because the metal isn't available. You can't ship what doesn't exist. So what happens instead? Physical silver flows east, vaults in the west drain, and the price gap widens. This is what a financial vacuum looks like. A vacuum that pulls metal toward the highest real demand. And that demand is no longer Western financial speculation. It's Eastern industrial necessity. This is the real power shift. Price discovery is migrating from paper promises to physical requirement, from futures desks to factory floors, from New York to Shanghai. And once that shift begins, it doesn't reverse easily. Now let's address the price action itself. Because yes, silver is moving fast, up 170% year to date, near $80 an ounce. This is parabolic behavior, and parabolas are dangerous. There's a law in markets known as the law of the parabola. The final phase of a parabolic move often contains the largest gains in the shortest amount of time, and then it often ends abruptly with violent corrections. That risk is real. It must be acknowledged. But here's the difference between this move and past silver spikes. This move is not being driven primarily by leverage or speculation. It's being driven by structural demand and physical scarcity. FOMO is present, yes. Retail participation is increasing, yes. But the foundation of this move is industrial, which makes it more dangerous and more powerful. Because when industrial buyers panic, they don't sell. They buy more. They front-run supply, they secure inventory, they sign off market contracts, and they remove metal from circulation permanently. This is where we are now. Smart money moved first, then institutions. Now the crowd is arriving, and that's when moves accelerate. Not gradually, but vertically. The risk is no longer whether silver is needed. That question is settled. The risk is how violently the market reprices to reflect that need, and whether the paper markets can survive that adjustment. Elon Musk's warning matters because it confirms something critical. This is no longer an investor narrative. It's an industrial reality. When the builders of the future start worrying about silver, you are already late to the awareness phase. And this brings us to the central question, what happens next? When physical reality overwhelms financial engineering? So what happens next? When a market built on leverage collides with a resource governed by physics, history tells us the answer is never gradual. It's abrupt. Because the silver market is not large. It only looks large because of paper. In reality, the total annual global silver market is tiny compared to equities, bonds, or even oil. And when you strip away derivatives, when you focus only on deliverable metal, the market becomes almost shockingly small. That's why shifts like this matter. That's why they move fast. And that's why they don't give second chances. Let S talk about the migration of price power, because this is the core of what is unfolding. For decades, price discovery happened in Western financial centers. New York, London, paper contracts, leverage. A system where price could be influenced without ever touching the metal. That worked when inventories were abundant, when supply was flexible, when industrial demand was stable, but none of those conditions exist anymore. Today, the market is tight, demand is accelerating, supply is rigid, and inventories are thin. Which means paper markets are losing their ability to dictate price. They can suppress temporarily, they can delay, but they can't override physical necessity. Shanghai understands this. That's why its price reflects urgency, not speculation, not hedging games, urgency. And once industrial buyers accept higher prices as the cost of survival, there is no ceiling imposed by charts or sentiment, only by substitution. And silver has very few substitutes. This is where the conversation shifts from price to risk. Because parabolic markets are unforgiving. They don't trend smoothly, they gap, they spike, they shake out participants, and then they continue, or they reverse violently, often both. If silver continues higher from here, it will not be clean. Expect sharp pullbacks, engineered sell-offs, volatility designed to break conviction. This is how stressed markets behave, not because the thesis is wrong, but because the system is fighting adjustment. But here's the uncomfortable truth. Volatility does not indicate weakness. In this context, it indicates strain. It indicates a system under pressure, and pressure is rising. Now let's address the question everyone is thinking about. Is this sustainable in the short term? Anything parabolic is unstable. Corrections are likely. Necessary, even. Markets don't move in straight lines, especially not markets transitioning between regimes. But in the medium to long term, the forces driving this are not cyclical. They are structural. Electrification does not reverse. AI infrastructure does not shrink. Geopolitical supply chains do not suddenly liberalize, and silver mining does not respond quickly to price. 70% of silver is produced as a byproduct, which means higher silver prices don't immediately increase supply. You need higher copper, zinc, and lead production to move the needle, and those projects take years. Recycling helps, but not enough. Less than 20% of silver is recovered. Much of it is lost permanently in electronics, gone. So the supply side is effectively fixed for the foreseeable future. Demand is not. That imbalance does not resolve quietly. This is why comparisons to past silver spikes only go so far. Those were largely monetary and speculative events. This one is industrial. And that changes the end game. Because industrial demand does not exit easily. It signs contracts. It stockpiles. It pays premiums. And it pulls metal off the market for years. This is also why the gold-silver ratio matters, but not in the way people expect. Yes, historically the ratio has averaged far lower. Yes, mean reversion suggests silver is undervalued. But more importantly, gold is monetary. Silver is becoming strategic. Strategic materials behave differently. They don't just appreciate. They become controlled, allocated, prioritized, restricted. And we're already seeing early signs of that. Export controls, licensing requirements, strategic stockpiling. These are not investor behaviors. They are state behaviors. Which brings us back to Elon Musk. His warning is not about price, it's about access. When the builders of the future worry about whether they can secure silver, you're no longer talking about a commodity. You're talking about a bottleneck. Bottlenecks don't resolve through optimism. They resolve through rationing or substitution. And substitution is limited. So what does this mean for participants watching this unfold? First, this is not a day trading environment. This is not a market for leverage. This is not a market for blind faith in paper claims. This environment favors unleveraged positions, physical ownership, long-term thinking, patience, optionality. It punishes overconfidence, short-term speculation, excess leverage, and assumptions that past market mechanics will always apply. This is a transition from abundance to scarcity, from paper confidence to physical constraint, from Western financial dominance to Eastern industrial pricing. And transitions are messy, they are uncomfortable, they challenge old beliefs, but they also create clarity. Here's the key takeaway. The price of silver is no longer just a number, it's a signal of industrial stress, of geopolitical realignment, of a system adjusting to reality. Whether silver pulls back tomorrow or pushes higher next week is secondary. What matters is that the underlying conditions have changed. Irreversibly, this is not fear. It's awareness. Awareness that physical markets ultimately dominate financial abstractions. Awareness that when scarcity meets necessity, price is no longer a negotiation, it becomes a verdict. And that verdict is increasingly being delivered in Shanghai, not New York. This story is still unfolding, in real time, quietly at first, then suddenly. And when the broader market finally recognizes what's happening, the adjustment will already be well underway. If this analysis helped you see what others are missing, like the video, share it, subscribe. Because the next phase of this story won't be explained politely. It will be expressed through price.